So it's 12:30. It's Thursday, and it's European Equities Day. And really pleased to have Stefan from BlackRock, manager of BlackRock Greater European, who's going to give us a short presentation and then answer some questions. Stefan, I was just thinking that it's a really good time to look at asset classes with a fresh pair of eyes when people have been selling them. And as you know, Europe had a pretty tough time from the perspective of sales of funds last year, with I think $100 billion of outflows, and this year hasn't been as bad, but certainly we haven't seen the tide turning and people buying European equities again. And there may be some reasons for that. And you know, it's very easy to get lost in headlines about weak economic indicators, but it's really startling, and that will come out in your presentation, how many great companies Europe has, and how diverse they are when you compare them to the US market and the UK market, and how outward looking many of them are. Yeah, there's a lot of really interesting things going on in Europe, and you know, with all these fund sales, valuations are looking pretty attractive at the moment. So you know, as I said, I think it's a really great time to just be taking another look at Europe. And so Stefan and the team have got a really good track record of navigating what is a big and diverse market over many years. And so Stefan, I'll hand over to you in a second to go through how you've achieved that track record and what investors should be thinking about going forward. But just very briefly, housekeeping. I think many of the attendees probably have been here on multiple days, but just in case you haven't, you'll see that there's a Q&A box down in the bottom right-hand corner of the screen. You can type questions in there. I'll be reading those whilst Stefan's talking, and after about half an hour, I'll reappear and we'll try and get into some of those questions. So do post anything that's on your mind in there, and we'll try to answer those. And with that, Stefan, I'll hand over to you.
Thank you, Alan, and good afternoon, everyone. Hopefully you can hear me okay. Yes, I'm Stefan Gries. I'm the head of the European equities team at BlackRock and the lead portfolio manager on the BlackRock Greater European Investment Trust. And we're going to use the time with you today to provide a general update on this trust, remind you briefly of the investment philosophy, and talk a bit about some of the compelling opportunities we can find in the European equities market at this stage. And as Alan is saying, there'll be an opportunity to ask questions at the end as well. Okay. So let's start by reminding you of the investment objectives of this trust, which is to deliver long-term growth in capital for our shareholders. To achieve this, we look at our addressable universe of over 2,000 listed companies, and we bring this down to the 35 to 45 most compelling investment opportunities that Europe has to offer. That means we build a relatively concentrated, high conviction portfolio that invests in some of the best businesses listed in our region, and currently the portfolio holds 36 holdings. Now, our job really is to construct this portfolio of what we think of as wealth creators, companies that often dominate their respective markets, and where we see that persisting for a long time to come. And ultimately our approach to running this trust is to identify a winning franchise in Europe, to size it large, and then to run those positions and let the value creation come through over time. And when we think about wealth creation more generally, we often think of it as having three key ingredients, which is high returns, growth, and time. And we're often surprised by how that last element, time, falls short for many investors, and people don't really let management teams execute on the strategies that they've laid out so clearly. Now, in this trust, we aim to be long-term owners of businesses. That means we target average holding periods of 3 to 5 years. And many of the companies in the trust we've actually held for much longer than that. And even in a volatile year like 2022, the turnover of the portfolio was only 17%, which speaks to that long-term approach. Just a few words on the team. So the team in total runs just under 22 billion pounds across 12 different strategies. This makes us one of the best resourced European teams in the market with 22 investment professionals covering the market by sector. And we're a hugely experienced team. Many of our analysts have covered their respective sectors for a very long time. We build a wealth of knowledge in important segments of the market. And what makes our team a little bit different from other teams is that we lead in a number of different segments. So we have one of the largest, I think the largest XEK franchise in the market, one of the largest income franchises in the market. We have value, and we also do a long short. And that means that when we come together as a group, we can challenge each other in a constructive way as different investors come to the table with different perspectives. And for us, good decision making is all about gathering as many different insights as possible, and we aim to build a complete picture as possible in all the companies we invest in. And this is also why over the years we have added new capabilities to the team. So we added a dedicated data scientist. Now 4 or 5 years ago, we added a forensic accountant, all with the aim of really leaving no stones untouched and building more knowledge than anyone else in the market. And we believe over time this should allow us to identify the businesses where we think the earnings power of the business is not fully reflected in market forecasts and evaluations, and thereby identifying stocks that have the potential to outperform the market on a sustainable basis. And that's really what the team is set out to do and how people are incentivized on the team. So as mentioned earlier, coming on to a little bit to stock picking criteria, but we mentioned our universe consists of over 2,000 listed companies, and quite a few of those businesses are really what we think of as global leaders in the industries they operate in. This is why we've also often made the point is that you don't necessarily have to have a positive view on the European economy to own this trust. Many of the businesses that we own should do well pretty much regardless of what happens to the European economy. And that's because when we pick those stocks, we apply some very strict stock picking criteria, as our companies are typically run by exceptional management teams with a very clearly defined strategy for value creation. It's companies that are higher returning on the capital they invest, and they generate significant amounts of cash, which then gives optionality to deploy that capital in growth projects at attractive returns. Now, when we think about wealth creation more generally, what we aim for is to carefully select businesses that align this trust to end markets and income streams that have the potential to create value on a real long duration basis. And that leads us in Europe to many of the enablers of the large transformational changes that are going on around us in areas like reshoring of supply chains, the energy transition, or decarbonization of transport. And of course, you find some leading businesses in areas like life sciences as well. And thankfully, Europe really has a lot of companies to offer when it comes to that bucket of enablers that are really helping to change the way the world is changing. Now, we put this slide in to talk a bit about how the macro environment can influence our thinking. The first thing to say is, we are bottom-up stock pickers. And this means while we take account of the macro environment we operate in, all of our views are formed from the bottom up. As a team, We do around 2,500 company meetings per year, and it is those interactions with companies across many different industries that tell us what's going on in the world right now. And this is, I think this is really important because each year there is a macro narrative in the market that asks you to change the composition of your fund. Investor conviction levels get tested all the time. And we've decided quite a long time ago that we're not going to buy into those macro narratives. For us, all decisions that we're taking on the portfolio are basically based on what we believe is happening to earnings and cash flows of the businesses, again, with a medium to long-term time frame in mind. And again, we like to remind our investors that we're not here to buy units of economic growth in the European economy. We buy units of earnings and cash flows in businesses. And in that context, it's important to remember why you own a business in the first place. So when the market is there to challenge you, what we do is we go back to what our original thesis was, and we ask the question, how much has really changed? And of course, sometimes a thesis does change, and then in those moments, you have to show that you can be pragmatic and intellectually honest. I think mature investors would demand that of themselves. But a lot of the time, we find it absolutely pays to be longer term in your thinking and to give management teams the time to let that value creation come through. Okay, coming on to positioning. I'm actually going to do this slightly differently. Let's start with positioning here at the sector level. You can see how the trust is positioned when it comes to different industries. You see relatively large overweights in areas like technology, consumer discretionary, and industrials. And then you see consistent underweights in segments like telecommunications, utilities, and energy. And for us, this is part and parcel of running a concentrated, high conviction, high active share portfolio. It means that if you think the medium to longer term fundamentals of a sector are unattractive, you don't shy away from stepping away from that sector completely. And when we think about those sectors that we have been underweight for quite some time, they all share quite similar characteristics to our mind. They're typically lower growth, they're often more capital intensive, lower return, and with that lend themselves less to value creation over the medium to longer term. We should also flag at this point that, as a team, as I said, we run long short portfolios. And what that means is that in areas of the market where we are running underweights, the chances are that we've built high conviction short thesis, which means that, again, we don't leave any areas untouched. We build high conviction short thesis. So we are high conviction both in our overweights as well as in our underweights. And that's what we aim to do in this portfolio. So ultimately, the team really looks at everything. And in this way, we're trying to eliminate any blind spots in the market, and with that, the portfolio. And as you see, overall, the portfolio remains overweight cyclicals and is underweight some of the traditional defensives. And we'll come onto our macro view in a moment, but ultimately we hold the view that if you step back and things like the longer term, 3 to 5 years, you want to be aligned of what we think of, again, are the enablers that happen to be listed in the European market. Bringing it down to the single stock level, we wanted to highlight here some of the areas where we have higher conviction in terms of single stocks. So as we've already mentioned, this is a relatively concentrated portfolio of what we think of as the most compelling ideas listed in Europe. That also means that our top 10 holdings typically account for up to 45 to 50% of the portfolio. Now, we absolutely want to make sure that we look at the portfolio overall and that we source the earnings and cash flows at the portfolio level in multiple different ways, and that those top 10 consist of companies across different industries, and that we source returns and earnings from the entire market spectrum. And that's exactly what a large and well-resourced team allows you to do. And conceptually, we like to own businesses that have a product offering that is so unique that it affords them a degree of pricing power. Now in Europe, we can find that in companies like MS. We also like to own businesses who operate in a duopolistic or oligopolistic market structures where demand is so strong that visibility on growth in earnings and cash flows extends over very long periods of time. And for us, Novo Nordisk, falls into that category. And lastly, we like innovative businesses where a new technology has the potential to completely transform how things are done in a given industry. And Dutch semiconductor equipment company BE Semi, with its hybrid bonding technology, clearly falls into that camp. And we'll take a little bit of time just talking through some of these names in a bit more detail now. Sorry. So one of the most exciting investment cases in Europe right now is that of Novo Nordisk, which is a global leader in the diabetes care market and in the GLP-1 segment. It does effectively operate in a duopoly with Eli Lilly. Novo produces a molecule called semaglutide, which has already experienced significant commercial success in diabetes under a brand called Ozempic. And that GLP-1 franchise for Novo accounts for about 50% of group sales. It is growing at 50% and it generates a gross margin of 90%. So when you think about that for a moment, it's clearly a hugely profitable segment and a big lever for the group. Now, to make things better, the prospects of the company are even stronger because they are also entering the obesity market through a drug called Wegovy, which is really the element that has been driving the share price by over 60% over the last year. And we think the obesity market has significant opportunity. They're estimated to be 764 million people living globally with obesity, and only a very small percentage of these are currently seeking help from a healthcare professional. Even fewer are treated with medication. And that's because the side effect profiles of a lot of the older drugs are unfavorable and means that patients don't tend to stay on those drugs. Now, for Wegovy, it has shown that the efficacy is very strong and there's very tolerable and amenable side effect profile. And there's now also a lot of data that we can see that basically shows that Wegovy has a massive opportunity to disrupt this market and help people remain on the drug for long periods of time. Now, the investment case became even better a couple of weeks ago when we had a trial readout that showed that this drug also reduces major adverse cardiovascular events by over 20%, an outcome that wasn't really expected by the market. And again, we think that those results will just help to underpin this validity of this new category, and more importantly, underwrite future growth in earnings and cash flows, for a very long time to come. Now, what we like here is that when we look at consensus expectations, as often is the case, forecasts are being faded really quite aggressively, go from the 39-40% the company grows this year to 22% next year and then 15% the year after, which we don't think is likely to happen because this company has been sold out for the last 2 years. They're adding a lot of new capacity. Pricing is holding up really strongly. And so we think Novo has the potential to over-deliver on what is currently being expected by consensus. MS is, again, probably one of the most unique businesses that we own. In our mind, this stock absolutely belongs to a select group of companies that we would classify as European royalty. It's unrivaled when it comes to the provenance and heritage of its brand and product portfolio and the pricing power that comes with it. In its most profitable division, which is fashion and leather goods, it takes up to 5 years to train a craft person to build the different handbags and leather goods by hand. And it's the only company we know of in that industry that enjoys up to 4-year waiting lists of its most iconic bags, like the Birkin bag, which can retail at prices well above $4,000, depending on the material that's being used. And so this company, again, finds itself in a very enviable position where it can't keep up with the demand, as its capacity can only grow by about 6 to 8% per year. And that means that many of the unique MS items that go into its relatively small store base are often offered to only the very best clients, and you basically allocated or invited for an opportunity to buy the product. And if there's a weakness in demand in one region, what MS can do is they can reallocate that supply to other regions where the demand is holding up strongly. And that's exactly what we saw while China was going in and out of lockdowns. The other bit we like here is that the company is family owned, and it's been run in a very conservative fashion for generations. And the family really only takes decisions with very long time frames in mind. And lastly, this business has shown exceptional resilience, and even in downturns has shown that it can grow through economic downturns and recessions. And just to give you a flavor, we had numbers from MS last week, and they're still growing 16% organically in 2023 as well. But clearly, the environment more generally is a little bit softer. And then the last company to mention before we come on to more broader topics is BE Semiconductor. Now, this was our best performing stock in the fund over the last year. This company designs and produces mission critical semiconductor equipment that's used by chip manufacturers, assembly contractors, and electronics and industrial companies. It is run by one of the best management teams that we know, and over the years, this team has done an excellent job at improving margins through the cycles. It is in the process, significantly increased, group margins, and it's basically become one of the most profitable semiconductor companies in the industry globally. So what exactly do they do? Basically, are a leading provider of packaging solutions such as hybrid bonding, which is set to become increasingly important technology in enabling semiconductor chips to become more powerful, become smaller, but also lose less energy. And you all remember that earlier in the year, a US-based chip designer said they were seeing surging demand for data center products used in generative artificial intelligence, such as ChatGPT. And for BE Semi, this is just one of the many end markets they cater to. But what is clear to us is that to meet the demands of emerging AI technologies, semiconductor chips will have to become more powerful, meaning chip manufacturers will need to markedly increase their use of products such as the hybrid bonding technology sold by BE Semi. And when we look at the future investment spent in the industry, which you can see on the right-hand side there, out to 2030, you can see very significant growth opportunities ahead, also for the companies like BE Semi, which is why we remain so excited about its outlook, and we think there's a long run rate of value creation ahead. Now, we also wanted to briefly comment on our relatively large exposure to European industrials. For us, this is the sector where we can find many of the companies that are enabling some of the large transformational changes that are going on around us. Companies exposed to the energy transition, electrification of our economies, or companies that are seeing huge investment spend on the back of the trend to reshoring supply chains. And in many instances, those trends are only just at the beginning and come after a long period of underinvestment from many corporates post the global financial crisis. In fact, one of the CEOs of a UK-listed rental construction company recently referred to this as a modern era industrial revolution with an unprecedented number of mega projects being signed off in the US and Europe right now. And as you probably know, in many cases, such projects are backed by government programs like the Inflation Reduction Act in the US or the European Chips Act, closer to home. And again, the chart on the right shows the significant uptick in manufacturing spend in the US, and many of the European companies that we own are set to benefit from this over the coming years. Okay, coming on to, actually before we do performance, there's one slide that was been missed out because I did want to speak briefly about our thoughts about the macro environment and to give you some food for thought as you go out of this session. So from our perspective, we all know that the macro indicators are relatively weak right now. And you can see that in the PMIs. We can see signs of slowing economies both in Europe and the US. And then you can, of course, ask the question, why is this a good time to buy European equities? And we would argue that positioning, as Alan was referring to at the beginning, is very low when it comes to allocations to Europe and very defensive right now. This is the longest talked about slowdown in the history of slowdowns, with market commentators first calling for a recession in Europe last year and then again, right now. Now, our view is that the weak data is arguably already reflected in valuations. The stock 600 is now trading on 10.5 times forward earnings, which is a level that we haven't really seen in a long time. We've also been seeing contracting PMIs and inventory destocking for a long time. Again, in fact, the longest decline on those metrics since the global financial crisis. And with that, many industries have already been in a downturn for up to 2 years. And the bit I always remind the team of, and we often share with our clients, is that as investors, we need to be forward-looking. The market is a discounting mechanism. And the question is not, what does the macro look like today? The real question is, what does the world look like as we move towards the middle of next year, the end of 2024, and into 2025? And we believe by then we'll be in a world where inflation levels are much closer to central bank targets, wages are growing in real terms, and central banks are likely to start cutting rates. And if they're not doing that, they will have clearly signaled by then that they're done with the rate hiking cycle. And from our perspective, we don't think the market will wait for evidence for this to happen. The market will anticipate, firstly, economic momentum stabilizing, and then for activity to start picking up again. And we really don't see the ingredients for prolonged and severe downturn. And, we can go into that again, maybe in some of the Q&A. Please do remember that by the time, strategists turn positive on a region like Europe, the market is likely to be significantly higher already. And this is why we think it's right to take the other side and continue to run a portfolio that is overweight cyclicals and not just on a 3 to 5 year view, but also on a 6 to 12 months view. And, just to reiterate that point, we think valuations in Europe look really very attractive today. And particularly when we compare that to the US market. And in many cases, for many businesses that we look at, a recessionary environment is already priced in. Then briefly to finish off, let's come on to performance on this slide. When it comes to performance, we believe we can deliver the best results for investors in our trust over the medium to longer term. You can see here that over 1 year, the trust had outperformed the benchmark by just under 2%. And if you cast your eyes over those 5-year numbers, you can see our share price outperformed its benchmark by just over 12% over the period. And that's really what our team is firmly focused on, to produce that growth in capital over the medium to longer term, because we think that it's over the medium to longer term, it really pays to take an active approach in European equities. And we see real benefits in that long-term approach of owning businesses rather than trading in and out of shares. And with that, I will hand it back to Alan, and we can start the Q&A.
Thanks, Stefan. It's really interesting, isn't it, that if you just read all the headlines and not looked at the numbers, and you were asked to take a guess what your 1 year performance was, you'd probably say it was down, wouldn't you? It's really striking how European equities have actually held up pretty well. I know it's been a slightly up and down market, but it's actually, as you say, that holding firm and taking a longer term view has really paid off, even in quite short term. So there's some questions about, there's quite a broad range of topics. Do you want to just talk a little bit, Stefan, about the team? There's a question about that, and you've obviously just made an internal promotion that's quite that was there was a press release on that a few days ago.
Yeah.
Do you want to talk a little bit about career development and how you bring people on, and also you mentioned you use people like behavioral scientists and how people like that help you make decisions. It's an unusual question, but it just sort of caught my eye that somebody's asking about the how the team all works and what their credentials are.
No, those are really good questions. So on the first one, so you're right, we recently announced that Alexandre Dangour is moving up to become a co-portfolio manager on this trust. And just to maybe provide a bit of context, so typically across different products that we run on the team, we like to have co-manager structures in place. Typically strong partnerships that form over time, and there's some obvious reasons for that, because you basically you add an extra pair of eyes, another brain. You in its most productive form, you have someone who can ask questions, challenge you on your views or on positions that are in the fund. But the way to think about this is these are natural progressions. So Alex had been working on the ex-UK book of business for a number of years now, and we felt the timing was right for her to be elevated and to be given the opportunity to step up and work more closely and more officially with me on this trust. The board was hugely supportive of this as well. They clearly met Alex and had a very strong impression as well. So I'm really excited to work more closely with Alex going forward. She's an excellent stock picker. She knows the market really well, and she's bringing different insights again and a lot of drive to the portfolio. So I guess that's a bit on the co-PM announcement. And then I guess on the second question, so we are lucky that we are working for a large and well-resourced team, and firm, I should say. I was referring earlier to our data scientist, Paolo Pugioni, forensic accountant, Ross King. The data scientists, so the data side we basically use to complement the bottom-up work we do on stocks. And it is amazing, actually, what you can do these days, the information and insights you can draw out of data sets in almost a real-time basis, whether that's on luxury goods spend, whether it's on wages, whether it's on sporting goods. And so we've the list of use cases has grown immensely over the last 3 or 4 years, and we just use those insights to complement the bottom-up work we do on individual stocks. And sometimes, again, it can help you to hold the line when the narrative in the market is particularly negative and when people are fearing the worst. And actually, very often we find that by looking at the data and using Paolo, you get the reassurance that actually nothing is falling off the cliff here, and the US consumer that everyone is working about is just is absolutely fine. But the you mentioned behavioral finance, because I've just, prior to this meeting, I just been with we also have behavioral scientists within the firm. And what they do is they analyze all of our trading, all of the trade commentaries we put whenever we put a trade on. And then it's an exercise of being brutally honest and tell you, this is where you add value, this is where you can improve. And we do that to try and continuously improve on the decisions we make on the portfolio and to become better at what we do for our clients. So we have that and internally as well, those capabilities, and we've had them, for quite a long time. And we do regular reviews with them at least twice a year to go through all of the trading we do on the portfolios.
Yeah, thanks. I won't ask you to share what your personal report said in the last quarter. Do you want to talk a little bit about a kind of investment trust specific features? There's a couple of questions about the sort of general pros and cons of running an investment trust, but I think there's other, the sort of specific topics I think within that would be good to look at are, we know your gearing's been increasing this year. Obviously that's a pro of investment trusts that they can use gearing. So do you want to talk a little bit about how you approach that and what investors should read into you increasing gearing? Because at a superficial level, you can look at it as a barometer of your positivity or negativity, depending on where it is. And then also the trust has been pretty resilient in discount terms, hasn't it? And maybe you just want to sort of briefly touch on some of the features of this trust that mean, there will be people on this call that love 40% discounts, and there are reasons why this trust might not ever be wider than its peer group.
Yeah. Okay. So I guess on the use of the gearing, and I mean more generally, we like the closed-end vehicle because you can go down slightly when it comes to market cap, and then, as you say, you can ultimately magnify the returns that you might be able to achieve in the more traditional open-ended vehicles by using gearing from time to time. Now, we would be the first people to say that we don't try to time the market. It's not a particular skill that we have, or I believe anyone can have. But the way we look at this is really, again, from a bottom-up perspective, and we use the gearing to add to shares where we think that they have been unduly penalized by the market and when opportunity has presented itself. And so, I mean, I'm quite pleased. This is very, very short term, but on a day like today, you want to be geared. And again, this means that the trust can do much better than some of the open-ended vehicles we run on the team. But again, it won't be a question of trying to time the market and changing it abruptly. It's all being driven by bottom up decisions. Then the second question, I guess, on the discount mechanism. So my understanding is that this within the European universe, this trust has traded at the narrowest discount of the peer group for quite some time. We did have a successful period of issuing shares in 2021, and clearly, more recently that has been tougher because our asset class has been out of favor. But important to say that the board takes that discount management really very seriously, and there's a tender mechanism in place. And so, if the discount moves out too much, there are biannual tenders in place for the board to try and manage the discount on that basis. But we've found that those are really very periodic, and in some instances we haven't really it hasn't been necessary to use the tender because the discount was kind of at the right level in any case. We look forward to the time where maybe the market as a whole takes a slightly more favorable view on Europe, because again, we think that there's lots of exciting opportunities, and with that, the discount should continue to move in, and let's see where we get to.
Yeah, thanks. And on there's a couple of questions on luxury goods, the luxury goods sector, and perhaps not there, and actually they're directed at LVMH. I think maybe it's not fair to get you to focus specifically on that company, as it's not one of your holdings. But the kind of general question is, can they really keep growing? What is the, I mean, in sort of simple terms, can we really expect rich people to keep buying luxury goods in tougher times? Is the kind of colloquial version of the questions. Do you want to just talk a little bit about that?
Yeah. So when you look at so we can talk about LVMH, and I guess what they all have in common right now, or at least the first thing to say, is that there's quite a big difference within the sector. So you had some luxury goods companies like LVMH and Hermes that were just outperforming a lot of the other European peers, and in some instances by a very wide margin. And for a decade, they were growing at 10% organically, very consistently. And by the way, if you go back even further, they also grew through, again, the global financial crisis in their fashion leather goods businesses. The only down year was 2020 due to COVID. Now, what happened then was we went from that 10% growth paradigm to more like 20-25. And that's the level they have been growing at for the last 2 to 3 years. And what was clear was that companies of those sizes, like an LVMH, eventually you can't keep growing at that rate, and there has to be a normalization process. Now, it's really interesting because we've just gone through a little bit of a softer quarter for them. But when we step back at the beginning of the year, beginning of 2023, the market thought they'd be growing 6% this year. Then it was clear, no, it's going to be much better. In the first half, they're growing 21%. And then we've seen a slightly weaker development in the second half, but they're still growing their top line by 18% this year, 18 to 19%, which again are really impressive numbers. But to some extent, they have become a victim of their own success. But importantly, when we look forward, I think the number for next year is now 7 to 8, which we're not particularly concerned about. And then again, I guess more broadly, where is the growth coming from? I guess we all know that a big part is coming from Asia and from China. And we look at the numbers that are moving into the affluent middle class, they're still enormous. And you're talking in the hundreds of millions, despite the fact that China has got a demographic problem. And so when we use Paolo, our data scientist, to look at the China cluster, there's no weakness to be seen. And we actually think that when travel comes back properly, that will be positive. So as in Chinese travelers coming back to Europe, that should be a positive because they end up buying at airports or in Europe, which is going to be a higher margin for these companies. And then the other bit that is often overlooked is how good they have been at opening up new markets. So Asia is one thing, but even in places like the US, they eventually realized, we're not really very well represented in states like Texas or some of the other affluent states, and they're starting to open up shops there, and that has been really quite beneficial. Same in the Middle East, and so there are other new opportunities they have been tapping into. And I remember actually doing work on MS 3 or 4 years ago, and we were astounded by how few stores there are in some of the key metropolis, like New York, or at the time we were looking at Moscow and other places. And sometimes you're talking about 2 or 3 stores, which is very, very little. In the case of MS, also very little kind of online. And so there's still plenty of opportunities for them to tap into different consumers, and they've done a really good job at recruiting new consumers to their brands over the years. But right now, we're going through a little bit of a transition, normalization of growth. But again, that has been reflected in forecasts now. And a company like LVMH will be net cash next year. It'll be trading on 19-20 times earnings, and 2024 might be slightly a lower growth year, but we of the view that, we'll then see that moving up again closer to the 10% average as we move forward. And on that basis, it remains really quite an interesting asset.
Yeah, thanks. And I think I should probably correct myself. I said LVMH wasn't the holding. I think it is a holding, isn't it? So,
yes, it is. Yeah.
Yeah. Just we just ticked over our time, but one last question I think it has come up, which I think would be good just to put some clarification on the name of the trust and its historic investment policy versus where you are today. Do you just want to briefly expand on that?
Yeah. Okay. So it's a good point. So this trust was launched 2004. The idea at the time of creating a greater European investment trust was to allow for the growth of countries and economies that were going to become part of the European Economic Zone and the European Union. And I guess with that, we were also always, since 2004, investing in what was deemed to be emerging Europe. So markets like Israel, Turkey, Poland, and also, Russia was part of that opportunity set as well. And so there was never more than, 5 to, let's say, 12, 13% of the portfolio. So the developed European part that we manage has always been the predominant part. And I guess the board had a long discussion on what to do with that opportunity set. And I guess the investable universe going forward, given that, Russia was going to fall away and, not just for a year or two, but it was very unlikely that market was going to be part of the opportunity set, for the foreseeable future. And so Sam Vecht, who had been the co-manager on the trust since 2004, stepped off at the beginning of this year. And with that, we were focusing predominantly on the developed European universe, which is what our team is looking at. Now, with that, I just want to make clear that, our team covers a lot of ground. And so if there are interesting opportunities, let's say in Greece or in Poland, they will come onto our radar and they will be covered by the team. And so, theoretically, we can keep investing in some of those markets, but you should think of this as predominantly DM focused, and I guess less, of the emerging European piece that we had in the past. And I guess that's the fairest reflection of the changes that were put through this year.
Yeah, thanks. It's good to make sure people understand that's the position. So, Stefan, thanks so much for your time. Really interesting discussion. I hope people go away and take a fresh look at European equities. This presentation will be up for you to view again, and the slides will also be available. And as ever, if there are any further questions, you know how to reach us, and we can always forward on questions to Stefan. So thanks, Stefan, and thanks everyone else for giving up your time today. And we'll see you on the next one tomorrow.
Thank you, everyone. Have a good day.